one. And welcome everybody to another episode of Smart Money Circle. I'm your host, Adam Sarhan. As always, I want to thank you very much for being here. Today with me is a very special guest. We've got Karen McClintock, CFA, CIC, Managing Director and Principal at Robertson Stephens, which manages nearly $4 billion. Karen, welcome to the show.
Thank you, Adam.
So Karen, I always like to ask, can you tell us your story and how you got to where you are?
Happy to. This is one of my favorite subjects, that is wealth management, and I am delighted to share my story with you. I had rather an unusual path into this industry. My undergraduate degree is actually in social work.
Oh, nice.
We don't find that much in my field. And after having been in this field for nearly 30 years now, what I find is I use my social work skills an awful lot of the time, Adam. It never ceases to amaze me. After I finished my undergraduate program in social work, I learned very quickly that I did not want a career in social work. I was not cut from that cloth. And I spent the next 10 years in advertising sales.
Oh, wow.
I decided to go back and get my MBA at USC with every expectation of it being with an emphasis in marketing.
Right.
So you can imagine my surprise when I sat through my first cost accounting class. And with a little bit of trepidation, we social workers didn't necessarily call ourselves long in math. And the teacher, the professor, did a quick overview of cost accounting and pointed out how at the end of the day, the balance sheet balanced. And I thought, wow, there's some beauty in that, the balance sheet balancing. And I made a quick pivot and ended up studying with some brilliant professors at USC, Jack Trainer among them, and ended up with an emphasis in finance instead of marketing.
Wow, I love that. So my background education-wise is poli-sci. I did poli-sci undergrad and then grad school. I started my business in my dorm room in grad school, actually. And I love that social element and that psychological element. I just published a new book. It's called Psychological Analysis, a third school of thought, fundamental and technical analysis, psychological analysis being master thyself so you can beat the market and hopefully live a better life and a great life. So I love what you're saying. I'm very interested to hear more. So can you tell us a little about your investment strategy, please?
Happy to. And I did take a peek at your book and was doubly delighted to be invited onto your show because I think we're kindred spirits in many ways. Our investment strategy, not surprisingly, is actually predicated on financial planning.
Okay.
To construct a portfolio without deeper knowledge of the client's fundamental goals and objectives would be like rearranging furniture in the dark. Somebody's going to get hurt. And so we put an awful lot of effort here at Robertson Stephens into financial planning to really understand the whole picture. And this isn't really just the warm and fuzzy stuff. That part of it factors in, but it's really critical for us to understand all the variables, the financial variables in the client's profile before we begin to construct a portfolio. Once that's done, we take a very disciplined approach to putting together a portfolio that's tax sensitive, that meets the objectives, that has a disciplined approach that can weather storms such as the one we are in right now. A really critical part of it too, Adam, is that the client needs to understand what we're doing. My clients don't need to have their chartered financial analyst designation, but if I'm going to ask them to white knuckle through a period such as today that we're going through, they need to have at least a sense of where the risks are in their portfolio, where the returns are to be obtained, what I'm doing constructively to manage through difficult times that require discipline.
So Karen, perfect segue to my next topic, which is risk management. But before we go there, by storms, you meaning corrections in the market, bear markets, market going down, not up. Is that what you mean?
Correct. Nobody ever seems to worry when the market's going up. That's a particularly prudent time for those of us who are disciplined to stay true to our asset allocation objectives. And sometimes a very hard time to stay true to our asset allocation objectives when things are going up. But the clients aren't really white knuckling it when we're going up.
Correct.
Clients are white knuckling it when we're in periods of extreme volatility, as we are in right now.
Got you. Okay, so before we go into the risk management side, I do have a question about the planning side and then the investment management side. So I've had other planners on, I've interviewed them, I've asked them about it. I love the fact that the rearranging furniture in the dark is just genius, by the way. So how do you handle the asset allocation process? Because a lot of our listeners are investors or do-it-yourself traders, or a lot of them are financial advisors as well that are looking for some guidance. After you have the financial plan, you understand the holistic view of the client, so to speak, or the investors, or however you want to word it, the trader. Then all of a sudden, you do what? Because that, I get a lot of questions after the show from people like yourself that, oh, I do the investment, the plan. Well, great. Then what is the next question? So how do you answer that?
That is a great question, and it is something that is constantly skipped over. There is a step in the financial planning process where we make assumptions in regards to returns.
Right.
Okay? Those assumptions can be aggressive, they can be conservative, but the assumptions are the assumptions. If at the end of the day, the plan is working for you, then you look at what those assumptions were and you construct a portfolio with asset classes, with historical rates of return that can meet those assumptions. Now, maybe stating the obvious, but if at the end of the day, you can't find asset classes that meet those assumptions, then maybe you need to revisit your plan. In a good plan, there are several levers you can pull. Easiest to articulate in a call like this is you can spend less or make more.
Right.
There are many other levers to pull, but you can spend less or make more. Well, if you really can't make more, then you might have to spend less or pull some other levers. But the bottom line is that the plan is predicated on some investment returns, and that investment return built into the plan is your framework for creating your asset allocation.
So that's wonderful. Thank you for that. So if you're expecting the S&P or the stock market, stocks as an asset class, to return 8% or 10% or whatever the assumption is, and that doesn't happen, let's say it returns double that or it returns half of that, how do you adjust and when do you adjust along the way?
Critical to the plan is your investment time horizon.
Okay.
And if the time horizon is long, then you don't necessarily need to adjust when those returns go up and down. The plan has incorporated some analysis that looks at historical volatility. And with the time horizon, you will weather that volatility. Your plan is created in such a manner that you can weather that volatility, and you don't necessarily need to make asset allocation adjustments because of the current volatility in the market. If your investment objectives change, if other variables come into play, yes, you definitely need to make a change. But asset returns are volatile by nature, and so the plan needs to incorporate that.
That's wonderful. So you look at upside volatility, but you also look at downside volatility, and that's incorporated into the plan.
Yep.
Okay. Risk management. So what mistakes do you see people make with respect to risk management is the first question I have for you today.
Thank you. Risk is a huge factor in our business. There's two kinds of risk. And I think the quantitative measures of risk are given an awful lot of press, right? Attribution analysis, correlation, managing concentrated positions. I fear the qualitative component of risk isn't given enough attention. What do I mean by qualitative risk? Qualitative risk is more a lifestyle risk. Qualitative risk is something a portfolio manager in the wealth area needs to really take a deep dive on. I can do all the analysis on the asset classes, the integration, the play between them. But if at the end of the day, my client comes forward and says, hey, I have an elderly parent and I'm now responsible for the long-term care, that should not be a surprise to anyone.
Right.
We should have ferreted that out early on, managed the portfolio in such a way with an eye toward eventually handling that extreme distribution so that it's not a surprise to anyone. So I think it's these qualitative risks that are oftentimes missed in deference to the quantitative risk measurements that we have in place. I think they're both critical. So I think one of the biggest mistakes is missing that qualitative side of it, understanding the client sufficiently.
Interesting. So I'm going to ask you another question here with respect to risk. Would you say overlooking the financial plan or planning process is a big risk that most people just want to jump right in? Hey, what stock should I buy or what assets should I invest in?
It's moving the furniture in the dark, Adam.
Okay.
Absolutely.
I thought you'd say that, but again, I just wanted to ask to get that clear. So now that we know the qualitative risks and you look at both the quantitative, but more emphasis on the qualitative as well, how do you handle the risk?
We understand the client. We do the financial plan. we actually do a financial checkup, which is the qualitative part of it. And we get into the details, the long-term care, the special needs child, the other family whose objectives might need to be met from multiple marriages. We get into those details, which are very, very qualitative, very personal, critical to making sure the plan is constructed properly, and we've considered all the variables and looked at their impact on the portfolio over time.
I love that. Okay. Before I move on to the next part of the conversation, I want to ask you about that risk just to make sure I understand it. So let's say you set the financial plan. How often do you adjust the plan? Do you do that quarterly?
Every year.
Every annually?
Yep.
Every year. So you dive in deep.
It's like when you go to the doctor, Adam. You go to the doctor and you have the same checkup every year,
Right.
just to make sure nothing's changed.
Right. Okay, perfect. And then if and when something does change, how do you adjust the risk or the allocation along the way? Is it saying, hey, listen, we should be more invested in riskier assets like stocks and less in bonds, or vice versa, or incorporate some other commodities, or whatever the case may be? Or, you know, how do you adjust the course once you realize that, hey, something has changed?
When I put together a financial plan, I like to bake in conservative assumptions for just exactly the scenario you're outlining. So that depending on the scale of the new information that comes to light, we input that data into the plan. And if we've done it properly, you don't want to be too conservative, but you don't want to be swinging from the branches either. If we've done it properly and it's not a change of significant magnitude, it won't change the asset allocation. It won't change the risk profile. It won't change how we're invested. If it is big, then obviously you need to make changes, and you need to look at exactly what you were outlining, the risk in stocks.
That's wonderful. So, okay, let's go back to extreme measures of volatility, since you and I both have some overlapping, like a Venn diagram, right? Some overlapping interests here with respect to psychology and sociology and so on and so forth. Back in 2000, 2008, were you involved in markets back then in current capacity?
Absolutely.
Okay, good. So I can ask you the question. What mistakes and or lessons, this is kind of a segue to my next question, did you see people make back then that can be avoided the next time we get into a big, bear market for stocks?
The good news is, Adam, is yes, I lived through those periods. Yes, I was managing through those periods and many other periods before that. Having done this for 30 years, I've got a flock of black swans behind me. Many of my clients have been with me for decades. We've lived through this before. That's a huge advantage when the markets become volatile, because we can talk it through. We can talk through our sentiments. We can talk through what I may or may not be looking at. We can talk through what I have on the whiteboard, but there's a tenure there. There's a track record. There's a trust in not only me and my decision-making process, but the markets as a whole. And so that's huge wind at our back during volatile times. However, there are new clients who haven't lived through me or these markets before. And that's a much more intensive counseling session, investment policy review section, a discussion of objectives, discussion of timeline, looking at data. We just put together a whole packet of data, and it was called Stay Invested. The data will always support your being invested, but the data is worthless unless there's a belief factor on the part of the client.
Right. You can actually execute. Okay. You can actually
and
follow.
It'll be executed, and that they'll really be okay at the end of the day.
Gotcha. That's awesome. So, okay, next question. What are some timeless lessons you've learned along the way that you'd like to share with the audience?
Personal favorite of mine is from Einstein, who suggested that one of the wonders of the world was compounding interest.
Yeah.
And the magnitude of that is never lost on me. Every time I do a future value calculation and look at the power of compounding math, I think I've done it wrong. Every time, Adam. And I'll do it again, and the number turns out to be right. I was in an Uber the other day, And the driver asked me, what do you do? Told him, oh, he says, would love to get involved. Don't know how, don't have a clue, don't know anything, and don't have any money.
Mm.
And I looked at his Venti, Starbucks, Frappa, whatever, in his
Yeah.
cup holder.
Right.
And I said, what did that cost you?
Yeah.
About $5. And I said, here's how you get into wealth management. I said, you come up with a nice routine at home. You do a really nice pour over in the morning. You put it into a really nice insulated mug.
Yeah.
And you take $5 a day.
Here's mine.
$5. There you go.
By the way, this mug, but doesn't matter.
Okay, if it was a pour over, you're still okay. Adam.
Exactly.
You take $5 a day, $25 a week, $100 a month. Set your bank account up to automatically transfer it to a brokerage account that you've opened in the name of a Roth IRA. I said, don't open your, sign up for electronic statements and don't open them but once a year on your birthday.
Mhm.
And just buy the S&P 500. You'll call me and thank me. And I came home and I put that calculation in with a 7% return. And after 40 years, because these, kid was in his 20s, there's $250,000.
Yeah, wow.
So I did the math again,
Wow.
because I was
Right.
sure it was wrong.
Right.
And I did it again. And then I thought, well, shoot, you put a zero behind some of those contributions and suddenly you're talking about some real money.
Monstrous.
One of the biggest mistakes people make is not starting early enough and not appreciating the power of compounding interest.
So let me just make sure I understand what you said. That $5 Frappuccino invested in the market, compounded out at 7% a year, became $250,000 over 40 years, you said?
Yeah.
Just, is it $5 a day? Or $5
5 days a week.
5 days a week. Okay. Take the weekends off. Okay, fair enough.
Yes. And I did it again, and the math works.
Yeah.
The more realistic part of it that I've experienced with my clients, Adam, is, again, I've been at this for a long time, and I've had the good fortune of working with many of my clients for much of that time. So call it 30 years ago, I was working with wealthy clients. They've stayed the course. They've lived through the black swans. They white knuckled through. They stayed with the program. They were disciplined. God bless them. And now, in addition to being wealthy, we're wrestling with huge estate tax problems.
Yeah, that with one of my guys. Yeah, I get that.
That's the power of compounding interest in real life, is they were
Right.
wealthy and now they're wrestling with estate problems.
Mhm. It's a good problem to have.
It's powerful.
So that, I love that. So timeless lessons, understand the time horizon, understand power of compounding, which is the eighth miracle of the world, if not. It's so powerful. Okay. Timeless mistakes and how to avoid them, in addition to being too short-term in nature. What else would you say are some timeless mistakes and how to avoid them?
Well, as you put it, number one, see Einstein quote above.
Right.
Number two, our industry is very transactional.
Mhm.
Right? We buy, we sell, we analyze, we look at data. There's aspects of portfolio construction, risk management, there's the planning process, all of which is very, very transactional. We don't look enough at the transformational part of it, the people part of it,
Transformational.
the transformational part of it, the people part of it, the part where I'm dealing with money, yes, but it belongs to people.
Right.
These people have legacy issues. They've got a sense of pride. They've got a sense of fear. They've got a sense of responsibility. There's lifestyles, there's children, there's heirs. There's a lot of transformational aspects to managing a client's portfolio.
Mhm.
I'm being brought in. It's kind of a sacred duty. I mean, I'm behind the curtain. These are intimate conversations we have to have in order to make sure we're managing the portfolio properly. It's a duty. It's a calling.
It
Not
is.
for everyone.
I loved it. You're absolutely right on that. So, Karen, next question. What advice would you give your 30-year-old self or 20-year-old self?
I got into wealth management kind of through a different path. But once I got into wealth management, the whole world of investment management was open to me. And I must say that on occasion, I was distracted by shiny objects. I was distracted by institutional management, where the bragging rights are huge, right? Oh, I manage a $4 billion public fund in, and in the aggregate, I manage, $20 billion, there's the allure of prestige associated with big numbers. I
can attest to that as well. I had the same shiny 100 parallel. We never met until today, but
fundamentally. Yeah, those Venn diagrams, Adam. They're
exactly.
again.
Parallel universe.
And then there you go. And then another one was the idea of managing a business, managing an RIA, managing a firm. That too was a shiny object because I do what I do it very well. I wish everybody did it the way I did it. And that's not a way to manage a firm.
Right.
And so at various crossroads on my path, I've had to step back and take a pulse check and remind myself of what my North Star really is. And my North Star really is providing my clients with peace of mind. I know it sounds cliche, by managing their portfolios properly.
So going back to the age 30, you tell yourself, avoid the shiny objects and focus more on how would you have known what the calling is unless if you said no to those other shiny objects?
They weren't a huge distraction because it didn't take me long to realize, oh, there are sharp elbows here. There's a lot more greed here.
Yes.
I really don't belong here.
Understood. Okay.
It didn't mean that I didn't come to those crossroads again and again.
Understood.
But at least I recognized the traffic lights a little bit better when I did.
Yep, 100%. So, okay, wonderful. And then what's the best piece of advice you'd like to share with the audience in general?
I'll give you three. The first isn't a surprise. See Einstein quote above. Number two, professional managers do more than manage your money. They help manage you through the difficult times, and we all need it. Nobody can do this alone.
100% agree.
Nobody can sit there and watch their wealth plummet by 15% and not want to run for the hills. That is not a solo sport. You need to have a team. You need to have a good team leader. You need to have professional management. And I'd say number three, and maybe this isn't in the right order, is that this is actually a fabulous career path for women.
Yes,
and it is heartbreaking to me to see that more women are not involved in it. When I got involved in this industry 30 years ago, I would go to my local CFA, Chartered Financial Analyst meetings. I would count. This isn't, a perfect scientific model, but I would count, and about 15% of the participants were women. And pre-COVID, I would go to the events, and 15% of the participants were women. And I raised a family, and I was not at I did not drive my son to school, but I'm on the West Coast, and I basically worked East Coast times. I picked him up every afternoon. I was at every game. I was at every practice. I was at every rehearsal. I was the mom who people thought was a stay-at-home mom. My kid went to a co-op preschool. I would take time off and run down and work at the preschool.
Right.
Run back and continue my work. Right. This is actually, I think, a fabulous industry structurally for women. And quite frankly, I think well suited for the sensibilities of women. I think that social
couldn't agree more.
Comes very naturally to women. And not that it isn't impossible for men, and I don't want to go down that path, but I think this is such a great career path for women, and I'm really sorry more women haven't pursued it.
I couldn't agree with you more. 1,000% agree. I think this is something that everybody that, like you said, not everyone's cut out for designed for this or has that DNA makeup in their brain or however that programming. But if you do have it, by all means, I couldn't agree with you more. Go for it. And women 1,000% should be more involved with this every which way to Sunday. Karen, this has been absolutely fantastic. I love it. Compounding. When you're done, compound some more. So that's the big lesson here. I love it. And thank you so much for coming on the show. And hopefully we'll have you on again soon.
Been a real pleasure, Adam. Thank you for having me.
Thank you.